What's up everyone, I'm Steven and welcome back to my channel. This video is all about Charles Schwab Options Trading, and today I'll be focusing on the cash secured put. I'm going to talk about what a cash secured put is, when you want to use the cash secured put strategy, and show you how to sell a cash secured put. The cash secured put with the covered call discussed in another video make up the wheel, which is a full circle income generating option strategy. The income you generate from a cash secured put is from the premium you collect. Money that goes directly into your pocket today and is yours to keep, regardless if the option is exercised at expiration or expires worthless. What is a cash secured put? The cash secured put involves writing a put option and simultaneously setting aside the cash to buy the stock if assigned. If things go as hoped, it allows an investor to buy the stock at a price below its current market value. You will need to have collateral, cash set aside, to be able to cover the option. This is one of the disadvantages to the cash secured put. You need to have the collateral or cash on hand to cover the option in case it is exercised. So if you sell a cash secured put option on a stock for a strike price of $10 per share and collect a $50 premium, you will need $1,000, as each option refers to 100 shares of the underlying security multiplied by $10 to equal $1,000 in case the option is exercised. Technically, and to be completely accurate, you need 100 times the $10 strike price to equal $1,000. Subtract the premium you collect. If we say the premium is $50 for writing the put option, which would be $950. When do you want to use the cash secured put strategy? You want to choose a stock that you will want to own, so it'll make it a win-win for you. You will either collect a premium as additional income, money in your pockets, or you will get the premium and 100 shares of a stock that you want to own at the price you want. Pick a stock you want, so you have no problem owning 100 shares of the stock. In this case, it is like putting in a limit order at a price that you want to buy a stock at, but you also collect the premium for doing so. If you're selling a cash secured put for purely income and collecting premiums, make sure you pick a stock that you're willing to at least hold for a short period of time. That way you can sell covered calls on it if the option gets assigned. Now let's show you how to sell a cash secured put with an option chain. Go to Trade on the navigation bar at the top, and under Options, select Chains. Enter the symbol or ticker for the stock you're interested in. Today, we'll use BlackBerry as an example. It will pull up the stock's current price at the top, showing that BlackBerry is down 53 cents for the day, or 5.01%. In the option chain, calls are on the left-hand side, and puts are on the right-hand side. The center column is the strike price. The strike price is the set price the option contract will be exercised at if reached at expiration. There is a lower premium for lower strike prices because buyers are not willing to pay much for the lower probability of the stock price dropping that low. There is a higher premium for a higher strike price, and an expiration date that is further out. If we collapse all, we can see we have multiple expiration dates to choose from. We see an expiration date of April 9th, 2021 pays a higher premium versus an earlier expiration date at March 19th. Let's go to March 19th expiration date and select it to show all strike prices. For a cash secured put, we will go to Puts on the right hand side and look under the bid column. The bid column is for selling an option, and the ask column is for buying an option. Under the bid column, we can see all the premiums that we can potentially sell our cash secured put for. The current stock price is at $10.05. Let's say we'll feel great if we can buy 100 shares of the stock at $9. We see that we will receive 51 cents per share, and when you multiply it by 100, as each option contract refers to 100 underlying shares, we will collect a premium of $51. We will click to enter the sell order and it will populate your sell order. Here we see that we are selling a put on BlackBerry stock with an expiration date of March 19th at a strike price of $9. We are estimated to receive $51 as our premium. For the order type, if we keep it at the limit price, the order won't execute until a buyer is willing to pay 51 cents per share, which is $51 for the option contract. We can change the order type for market order to have it execute at the best price available. So the estimated price you receive is still $51, and once the order executes, it might be $1 more or less. Hit Review Order. On the next page, you will see a summary of the order you are about to place. Confirm everything is correct. You will see your estimated premium, and after the estimated commission, you'll be receiving $50.35 directly into your account today. Simply hit Place Order and you are all set. Congratulations, you have sold a cash secured put. Here's what can happen after you sell your cash secured put. Number 1. BlackBerry does not drop to or below the strike price of $9 at expiration. If that happens, you get your collateral back, and you would have made the money off the premium. This is what happens when the contract expires worthless, and for people looking to generate income, this is the desired outcome. You would get to keep your collateral because you didn't have to purchase the 100 shares, the money you made from the premium, and do it again. Number 2. BlackBerry is at the strike price or below at expiration. Then you will be required to buy 100 shares of BlackBerry. You will buy 100 shares of stock you want to buy at the price you want to buy it for and make money off the premium. If you now just want to hold the stock for the long term, you can. Or if you want to continue the income generating wheel strategy, you can sell covered calls, which I covered in a previous video. One thing to consider is what is the worst case scenario for the strategy. The worst case is that if the stock price drops to 0, you would still have to buy 100 shares of the stock at the agreed strike price. That would suck, but it's not very likely. The company would have to go bankrupt or completely go out of business. What's more likely is that the stock price drops a few dollars below your strike price. In that case, you lose money from that difference. How do you mitigate that loss? This should be a stock that you do not mind owning. So if the stock price does drop a few dollars in the short term, you should have belief in the business and that the price will climb back up and you don't mind holding for another year, 2, or even more. Or you can sell covered calls to collect premiums over time to make up that difference. Always understand your risk and reward before trading. Invest for your financial future. If this was the type of content you like, go ahead and hit that like button and hit that subscribe button. Hit the notification bell for more videos delivered to you. If any part of this was confusing or you have any other questions or comments, feel free to leave that down below, and you guys have a great one.